Welcome back to Halftime Report on CNBC TV18. Now, while obviously we have a lot of updates that come in from US President Donald Trump overnight, we had him levying 50% tariffs on copper imports and has threatened to impose 200% tariff on pharma. We're still waiting as India's deal is still pending, so waiting out for that. What are going to be the implications of all of this? We have Fook Hien, who is a senior investment strategist at Standard Chartered Bank, joining in with us to talk to us about the overall global trade and what we are expecting to see in terms of equities. Fook, good afternoon, and thank you so much for joining in with us. While obviously, you know, the first half of the year that we look at it has been mainly related to President Trump, trade war, tariffs, global and geopolitical tensions that continue as well. But in terms of equities, now what are we watching out for? You know, India is still left and pending with the deal still coming with US. What should we watch out for now?
Yeah, thanks very much. Thanks for having me. I think we are still constructive on the environment. Obviously, the first half with Liberation Day, Trump saw a lot of changes. And I think that can be ongoing, that can continue. Look, the average tariff levels will be higher. I think we know what to expect. My question is where it settles at. But really, I think what the market wants is certainty, right? What the market does not like is the back and forth and uncertainty. I think once we are nailed down and having more certainty and having more clarity, that will be positive, as the companies are already expecting this in terms of the inventories. We saw a lot of front loading, but it's really the certainty that they need to nail down so that they can adjust their investment plans a little bit better. I think we're looking beyond the geopolitics and just stepping back and looking at the fundamentals and the economy and whether growth can continue. And we still are in a soft landing camp on that basis. And as long as the growth continues, if we avoid a recession, especially in the US, that environment is still positive for equities, positive for global equities. So we are constructive overall in this environment because we do expect a soft landing, especially in the US. Now, a big trend for us, though, is a weakening US dollar. And the weak US dollar is something that we're telling investors to be positioned for. And a weak US dollar tends to be better. While one is good for equities overall, and two is good for equities outside of the US. So we're looking for a diversified equity portfolio with a tilt towards Asia ex-Japan because we believe that they would benefit from a weak US dollar environment.
Okay. Fook, while we wait by for the details, how feasible or realistic do you think a couple of these headlines are? For example, 200% levy on foreign drugs. That in itself would be detrimental to the US itself.
Absolutely. I think we hear mixed comments on that. I think I've also heard him say that we'll give them 1 or 2 years, possibly to bring production onshore. We see a lot of pharma companies committing into it. And look, I think he is trying to get headline wins in terms of, we're seeing X billion of investments in the US, which is going to create X number of jobs. And I think that is very much what he's looking for. He is kind of adhering to the promises that he made during his campaign. And so he's following through with that. But in terms of the impact on the consumers, impact on healthcare, at the end of the day, I think moving into the end of the year, when a lot of the politicians will be looking towards midterm elections and preparing for midterm elections next year, they will be very conscious as well on how the impact on cost, impact on sentiment is. We've seen a lot of survey-based data being very downbeat. Even though the hard data is looking good, the soft data is quite downbeat. So coming into year end, I think they'll be much more sensitive as to the impact they would have on cost, impact they have on sentiment, because they need to win the election next year. So a lot of high numbers at the moment. I think he's trying to secure a lot of commitments, but the commitments from companies are also multi-year commitments, right? And they will last through his second term. So I think it's the headline win that he's looking for.
Okay. Fook, you did highlight that in terms of equities, ex-Japan in Asia, what are the markets that you're liking? What's your pecking order?
Great question. Thanks for that. Pecking order, I would say we are overweight on China and overweight on Korea at the moment. India is a core holding for us, and we do like the structural growth longer term. Why we are overweight on China and Korea, we're a bit more sensitive to valuation. Their valuations there are cheaper. And we believe there is a catalyst as well in terms of improvement. In China, we're looking out for more policy stimulus. There's a lot of stimulus in there for consumption and for white goods at the moment, but also more in terms of the AI development we expect, and there'll be a catalyst for the Hang Seng Technology Index especially. So that is going to be supporting China, and valuations are still very attractive. And Korea is another market where post-election, I think President Lee there with his KOSPI 5,000 and the measures that he's introducing there is again very supportive for a market that is very cheap, less than 10 times PE. So we think there's still scope for re-rating in Korea. These two markets are our preferred markets. India, very good structural story, longer term. I think our preference within India is in the mid-cap size, where we're seeing much higher earnings growth, which justifies the valuation premium. But for the overall India large cap index, we're very a core view at the moment because the valuations are high and then the earnings are still good for the midterm.
Okay. Fook, any changes to your India structure based on the trade deal that you're watching out for?
India's structure, I mean, in terms of the sector?
Your India holding.
Okay, well, I think no. At the moment, no. I think it remains a core holding. I think we might change our views a bit more nimbly around the large cap versus the mid cap. At the moment, we do prefer the mid caps. And we don't really expect India to be disadvantaged, versus the other countries. Look, I mean, all countries, exporting in the US are going to be facing higher tariffs. We've seen Japan and South Korea already at 25%. Being rolled out. And so all of them which sell into US will face these kind of headwinds. But India has got a lot of domestic strength within itself, a lot of structural strength. And that's why we think that will sustain the earnings. And it's going to make us, it's a core holding for us within Asia, Japan.
Okay, Fook, just a quick one. Last time you mentioned you were overweight on gold. Continue to be overweight on gold, or do you like silver as well now?
We are neutral on gold at the moment, so gold is the core holding. We are still telling investors to have gold in the portfolio, helps to diversify, and in a weak dollar environment as well, gold tends to be an asset that will do well if you look at the correlations. So gold is neutral, but definitely it's something we would keep within the portfolio. Silver is something that we've got not necessarily a house view on, but preference really is with gold. The central bank buying as well is another place, a positive factor for gold.
Okay, all right, Fook. We're going to leave it on that note. Thanks very much for joining in and speaking with us. So that's a quick update coming in on the global perspective. Well, for the markets, extremely quiet at this point in time, just about in wait and watch terrain. We'll take a short break. But as we do that, remember to tune into the all-new CNBC TV18 Prime, bringing you insights from policymakers, business leaders and economists shaping both the world and India's future. CNBC TV18 Prime decodes global shifts and their impact on Indian businesses, giving you unparalleled insights. Tune into CNBC TV18 Prime at 12 noon for the Global Reset, at 1 p.m. for the Big C, and Global Lens at 8:30 p.m.